Welcome to Value Vest Daily. Today, we're unpacking one of the boldest moves in recent corporate history, Tesla's absolutely massive $25 billion bet on the future of AI. Now, before we get into it, just a quick reminder. This explainer is for your information only. It is not financial or tax advice. You've always got to do your own research. So what if a company, one of the biggest in the world, basically decided to bet the entire farm on AI and robots? Well, that's pretty much what just happened. On their latest earnings call, Tesla dropped a bombshell that has Wall Street scrambling. And get this, it has almost nothing to do with selling more cars. Elon Musk signaled a hard pivot, effectively pushing all the chips in on artificial intelligence, on humanoid robots, and on a massive fleet of driverless robotaxis. This is the path he sees to becoming a multi-trillion-dollar company. And it fundamentally changes everything about how we need to analyze this business. And the pivot came in the form of this number right here. Over $25 billion. That's the capital expenditure they announced for this year alone. Now, to give you some perspective on just how wild that is, it's nearly triple what they spent last year. It's a truly staggering figure, and it's not just a budget increase, it is a loud and clear signal of a massive intentional shift in strategy. Right, so the main takeaway is this. Tesla is screaming from the rooftops that it's no longer just a car company, it's an AI and robotics company, full stop. But here's the billion-dollar question, or I guess the $25 billion question. Does this make it the ultimate momentum play, a rocket ship you absolutely have to be on right now? Or is it a classic value trap, a move that's just going to incinerate cash for years with absolutely no guarantee of a payoff? Well, that's what we're here to figure out. We're going to break down the numbers, the tech, and the enormous risks involved. Okay, so to really get our heads around this pivot, we first have to look at the numbers that set the stage, which came from their Q1 2024 report. The quarter itself, honestly, was a bit of a mixed bag, some good, some bad. But it was that spending announcement that completely overshadowed everything else. So, looking at the core numbers here, you see a picture that's, well, it's mixed, but generally pretty resilient. Revenue at about $22.4 billion was a slight miss, which kind of points to some softness in the global EV market. No big surprise there. But, and this is a big but, the non-GAAP earnings per share came in at 41 cents, which was a solid beat. That shows they're really managing costs well. And here's the one everyone was watching. Auto gross margins. They bounced back to over 21%. This is so important because it shows their core car business is still a cash cow, even with all the price cuts. And finally, they generated $1.44 billion in free cash flow. That proves the business is still an engine that prints cash, which is kind of critical when you're about to spend the way they're planning to. But really, this chart, this is the whole story of the quarter. You can forget about the slight delivery miss for a second. Just look at this incredible jump in capital expenditure, or CapEx. They're going from around $9 billion last year to a new guidance of over $25 billion for this year. This is not a small increase, people. It's a massive pedal-to-the-metal acceleration of spending. This is the pivot right here in one simple chart. And this slide just perfectly illustrates that change in identity. Think about it. Tesla today, it's an EV company, right? It's dealing with slower growth and a market that is getting more competitive by the day. But Tesla tomorrow, the company envisioned by this spending plan, that's an AI and robotics juggernaut. It's chasing trillion-dollar markets where the margins could be sky high. What they're doing is sacrificing some of that near-term certainty for a legitimate shot at total market disruption. So, the big question is, where is all this money actually going? I mean, this isn't just some vague promise. They've actually detailed where this historic $25 billion investment is being put to work, and it tells a very, very clear story about their priorities. All right, this slide right here is really the heart of the whole new strategy. Let's break it down. A huge chunk is going to AI training clusters and Dojo. Now, Dojo is Tesla's own custom-built supercomputer. It's designed for one thing, to process insane amounts of video data from their cars to train their self-driving AI. This is a direct bet against using off-the-shelf stuff from, say, NVIDIA. They're betting their custom hardware is better. Next up, new chip design. By making their own silicone, they control the whole thing, hardware and software, making them work together perfectly. That's a powerful competitive moat. Then you see it, dedicated factories just for the Optimus humanoid robot and a production ramp for the Cybercab robot taxi. This isn't just R&D anymore. They are building the infrastructure for mass production. Literally, every dollar here is aimed at building the physical foundation for an AI-powered future. Now, on the earnings call, Elon Musk justified all this spending by pointing to the almost unbelievable economics of these new businesses. I mean, think about robotaxis for a second. Once you build the car, it's a fixed asset that can just generate revenue for you 24/7. And with no driver to pay, well, almost all of the fare becomes pure profit. Some analysts are throwing around numbers like 90% margins.
You compare that to Uber, which has to pay out most of its revenue to drivers. It's a different universe. And then you've got Optimus, the robot. If that works, it could fundamentally rewrite the entire multi-trillion-dollar global labor market. It's audacious.
But there's always a but, right? There's a cost, and it's going to hit right away. This spending spree means Tesla is fully expecting to have negative free cash flow for the rest of the year. That's the short-term pain. The company is literally burning cash to build this future. The key thing to remember, though, is that they're funding this internally from their own very strong balance sheet. It feels a lot like Amazon back in the early 2000s when they reinvested every single penny to build out AWS and their e-commerce empire. Okay, so that's the plan. That's the logic. It's a huge vision. But is any of this real yet? Is there any actual tangible proof that this massive bet isn't just some sci-fi dream? Let's take a look at the momentum they're already building. And the answer is yeah. It looks like we are seeing real, tangible progress. If you look at this data, paid robotaxi miles nearly doubled just in the last quarter. That's an early sign of real demand. But here's the more important part. Fully unsupervised commercial rides, we're talking no safety driver in the front seat, are now live and operating in 3 major U.S. cities: Austin, Dallas, and Houston. But the most critical data point on this whole slide might be this one: 0 incidents reported. For this tech to ever scale, safety is everything. So far, so good. And they're already working on permits to expand. This isn't just a promise anymore, it's actually happening. And here is the roadmap they've laid out. This isn't some fuzzy 10-year plan. They're saying low-volume production of the Optimus robot is set to start this summer. The production lines for the dedicated Cybercab are being prepped for late this year, and all of this is building towards 2027, which a lot of analysts are now circling on their calendars as the potential inflection year, the year when robotaxi revenue could finally start making a real dent on the income statement. So why might Tesla pull this off when so many others have struggled? Well, it really boils down to 3 key advantages. First is scale. They have millions of cars on the road right now, and that entire fleet acts as one giant global data gathering network. Second is the data itself. That fleet has collected billions and billions of real-world driving miles. That creates this data learning feedback loop that is just incredibly difficult for anyone else to replicate. And third, and this is so important, is vertical integration. Competitors like Waymo, they buy cars and then they stick their tech on top. Tesla designs the car, the computer, the chips, and the software, all in-house. That gives them a level of control and cost optimization that is just a massive structural advantage. Which brings us all the way back to the main event. The central question: after seeing the numbers, the strategy, the progress, how should an investor actually look at this? Is this a brilliant momentum play, or is it a dangerous value trap? Let's just lay out both sides of the argument here. The bull case, right? The momentum play, it's all about explosive optionality. If robotaxis or Optimus achieve even a tiny fraction of their potential, the upside is astronomical. But the bear case, it points to the massive cash burn, the huge regulatory and safety hurdles that are still ahead, and a valuation that's already baking in a whole lot of success. And this pivot just completely shatters traditional ways of valuing a company. Your standard DCF model based on selling cars, it's pretty much useless now. You have to try and model these new, completely uncertain, but potentially enormous AI revenue streams. And that's exactly why you see such a huge split between the bulls and the bears. So what's the verdict? What's our take? Well, we see this as a momentum play that is now morphing into a potential deep value opportunity. But, and this is a big but, only for very patient investors who have a high tolerance for risk. This $25 billion bet, it doesn't really seem reckless. It looks more like a calculated strategic offensive to dominate a new industry. The risk is undeniably high, no question, but the potential reward is what you call asymmetric. So for anyone with a 3 to 5 year time horizon who really believes in an autonomous future, this pivot could be a truly defining moment. So if you're an investor or you're thinking about it, what should you actually be watching? Here are 3 things. First, keep a really close eye on those robo-taxi expansion milestones. Are they actually getting permits for new cities? Second, watch for public demos of the Optimus robot doing genuinely useful, complex stuff in the real world. And third, you have got to monitor those future free cash flow reports to see how quickly they can get back into the black after this heavy investment cycle. These are the real proof points. So the bottom line is pretty simple. The Q1 report showed us that the core car business is holding its own. It's fine. But the real story is that Tesla just placed one of the single biggest bets in corporate history on its ambition to become the undisputed leader in real-world AI and robotics. But now I really want to hear from you. What do you think? Is this a moonshot that's going to redefine the company and maybe even the world? Or is it a classic value trap that's just going to burn through billions? Drop your price target and whether you're a buy, hold, or sell in the comments below. Let's really get this discussion going. If you found this deep dive valuable, please subscribe, like, and share ValueVest Daily for daily learning opportunities before you put your money to work. Your support really helps us create these explainers on the market moves that truly matter.
And one more thing, please put in a comment if you want us to deep dive into any specific high-risk, high-reward opportunities. Thanks for watching.